Welcome to the Del Walmsley Radio Show. Listen and grow as Del questions the status quo, encourages you to think differently, and empowers you to make a better life. Get ready as Del challenges core beliefs, seeks the truth, and reveals the roadmap to the lifestyle you really want. And now your host, multi-millionaire, national award-winning investor, CEO and founder of Lifestyles Unlimited, Del Walmsley.
Welcome to the Del Walmsley Radio Show, where the hype ends and the help begins. I'm your host, Del Walmsley, and as always, we're working on your financial freedom. My friends, sometimes from day to day, these shows do not tie together. And they're just whatever it is I want to talk about that day, specific information that you can garner everything from either one segment or the whole show, tie it all together. But today is a show where I'm going to talk about really what I've been talking about for over a year now, and really how the market has changed, what is happening, how it has changed, how that is affecting the real estate investors out there. Now, the reality is that anybody out there that wants to sell you real estate does not want this show to occur. It hasn't wanted my show to occur for the last year, where I've brought up the reasons why real estate investing are more difficult, if not impossible, to make profitable. You say, well, Del, isn't that all you ever talk about? Is how profitable real estate is? Real estate is unbelievably profitable. And I still have not lost any money in real estate after 35 years of doing it. Those are still true. Rule 1, still don't lose money. Rule 2 is there has to be cash flow, and it's harder and harder and harder to find cash flow out there in the marketplace today with these interest rates. Rule 3, though, is you can't get rich slow. You got to be doing something that creates great gains. Well, today, I'm going to show you how all three of those rules have been stepped on over the last 12 months, and really how you decide how to wander into that forest of bear traps. But you have to understand this. The reason I'm doing this particular show today is because the commercial brokerage world is starting to give in and admit that it's actually happening. Yes, I told you they would never give in and admit it, and they are reluctantly sticking their toe out the door going, hey guys, things are messed up. And to understand that when things are messed up is to say that's good for us is really difficult for someone from the outside world, because I'm going to give it to you in the short. In the short, if the real estate market gets messed up bad enough and things go sideways long enough, then deals start to drop out of the sky. Deals where people have done things that were wrong, which are all the things I'm going to cover today. And those things are going to create situations where they got to get out of a deal. They got to get out of a property, and they got to let it go. And we swoop in because we are not hurt. We are not wounded. We have money. We're ready to go. And we swoop in and take advantage of the situation. So in other words, we make a lot more money when the market is destroyed than when it's just clicking along as a normal market. Now, as a normal market, all of the things that we talk about in real estate are true. In this type of a market, those things are no longer true, but other things are. And that's what you got to get out of today's show. Also, late in the show, if I have time, I've got 3 people that had personal questions that they wanted answered, and I'm going to get to those in the last segment if I can squeeze those in. So let's get started. Marcus and Millichap, one of the most prominent real estate brokerage firms in the country, who does probably more advertising for commercial real estate than any other marketing or any other real estate brokerage firm for commercial real estate that I've ever seen. I mean, they're just all over the place. I get an email every single day from them, sometimes 2 and 3 in a day. They are just marketing the heck all the time. And they have a guy who does their presentation that I've never seen a guy that could be going down on the Titanic and be giving you a presentation like, well, it doesn't really mean anything. We don't really know if the ship's going to sink. If it does, there's probably ways that we can make money out of it. I mean, this guy is just never seen him shook ever. And in this particular case, it's just incredible to listen to this guy be forced to change his tune. However, he still does it with a smile on his face, and he still does it as if it's no big deal. But you can read between the lines if you listen to this guy every day. These guys are hurting. Stuff isn't selling, and they're not making the commissions. Their brokerage firms are down. Now, how do I know that? I own real estate brokerage firms in 10 different states. I know what's going on out there. We see it. We have same situations they're running into. And as I go over it today, what's actually happening in the marketplace, I can attest to the fact that I know, not only because I'm an investor, I own brokerage firms, so I see it at the brokerage level. I own a mortgage company, so I see it at the mortgage level. And, we have all these clients that are out there that are investors that are seeing it at their level. So I'm seeing it at multiple levels. I have a very clear shot of what's going on. And I want to share it with you today. So the first thing is the statement of the video that this guy puts out is called 5 Significant Challenges that the Commercial Real Estate Market is Facing. 5 significant challenges, right? And so that's a very calm way of saying they got some problems. And the first one, of course, is the feds have increased the interest rates. I mean, the interest rates have gone from really 2.5%, they say 3% to 5.5% to 8%. So I was looking at an apartment complex the other day, and the interest rates I was looking at were 5.6 to 5.9. This was on a Class A apartment complex with only a 56% loan. Normally, loans are 80%. When the deals don't make sense, the bank wants less risk, they'll go down to 70%. For 35 years, I've never seen loans go below 70%. Then they went down to 60% because none of the sales prices that the sellers are out there trying to get make sense. And the banks know it, so they only want to lend 60%. But when a seller thinks his property is really great and is trying to sell it pro forma, trying to sell it for what it will be next week, next month, next year, these deals don't pencil. And so the deal I went after, by the way, I'm going to talk about it today, was my dream deal. This was Class A apartment complex, 2 miles from my house. Everything I've ever wanted to own was my wife could be, 2 miles away from my house to operate this thing. I wanted it. In fact, the want was so bad that I almost made a mistake and bought it. But I didn't. The interest rates have changed, the cap rates have changed the prices and the market valuation. Now, the interest rates have also pushed some properties with variable rate mortgages into real debt problems. Some of these guys out there, and by the way, I've talked about this for 3 years now. I did a video live at the last Expo where I took clips from the last 3 years telling people don't get into variable rate mortgages, don't get into variable rate mortgages, don't get into variable rate. Told you 3 years in a row, people did it, and now they're getting eaten. They bought in at 3% thinking, okay, I'll buy a cap that it won't go above 4. I'm going to take insurance that if it goes up, it won't go up past 4. Well, they didn't understand that the variable rate cap was based on a yearly basis and that they had to buy a new cap every year and that 4 didn't make it. Interest rates went up to 5, 6, 7, and as much as 8% on some of these variable rate mortgages. And these people are now hurting bad. To survive, they're going to have to bring cash to the table to float the note, right? They're going to have to feed this monster now. And there's going to be a lot of people out there that this is happening to. Now, to get out of that, they're going to have to either sell the property and or refinance the property or thirdly, recapitalize the property. What are the 3 different things? Sell, they're going to have to go out there and find somebody who's willing to pay for it. The problem they're going to find is that no one's going to be willing to pay for it unless they're just an idiot, just getting into the business, doesn't understand. But they're not going to pay the price that these people paid a year or 2 ago with the interest rates what they are now. And so they're going to have to lose 50 to 100% of their equity. In fact, Marcus Millichap said, hey, some guys are trying to sell just trying to get 50% of their equity back. Some people are trying to sell just to get, any portion of their equity back. And some people were trying to sell just to get their name off the mortgage, off the note. They were taking a loss, and this is occurring. Now, they don't want to make that public. They don't want that out there because, this is something that would scare people from buying real estate right now. It doesn't scare me from buying it right now because you can see where you're at. If you're at the bottom of the gully, when you're sitting there and the problems are all there, you can correctly evaluate the risk associated with where we're at. The people that are in trouble are the people that didn't correctly foresee the future of those variable rate interest rates, didn't foresee the future of their projections of how the value would continue to go up, even when the interest rates were going up. They just didn't see it. And, that's because they haven't been around the block. I'm almost 70 years old. I've been through this thing. I've been through 3 cycles now. I mean, to me, it's like, okay, here we go again. No big deal. I see what's going to happen, right? And so you can recapitalize, means go back out to your investors, say, give me a lot of money and let's restart this process, which nobody wants to do. You can try to refinance, but the problem with refinancing is there's new loan requirements that weren't there 6 months to a year ago. The debt-to-income ratios are much stricter now than they were a year ago. And so you might have to bring money to the table just to refinance the property, even though it should have gone up in value. It actually hasn't. The debt-to-income ratios are more difficult to hit. They've made them more difficult to hit. And not only has interest gone up, insurance and property taxes have gone up in most cases also. So now there are many, many cases upside down on these properties. And they're just trying to figure out how to get out of it. One guy here in Houston, Texas, lost 2,400 units after only owning it 1 year. Now, this guy should never have been in real estate. He came from one of those, guru seminar programs, educational programs, and they don't know what they're doing, right? And there's no one there helping them, or maybe they do know what they're doing, but they don't listen, and they do it anyway. This guy obviously was one of those guys that didn't listen or just did whatever he wanted. You've got additional problems. You've got some people whose loans are coming due. So not only do they have the interest rates adjusting on them, some loans are coming due. And when those loans come due, these banks want out of those loans. And so people are going to get whacked on those because they can't refinance. There's really no way to get out of these things except take a loss. There just really isn't, because the bank isn't going to bail you out of this loss. They want out of this loss. They're in an upside-down situation in these things also. So it's very, very difficult. Secondly, banks don't want to lend for a second reason, because you've just had a couple banks fail. And they're trying to get liquid. They're trying to get more money, more cash into them to be more stable as a bank. And so some banks have just stopped lending. So the amount of available capital out there has gone down. And there's only just a few places where you can get loans anymore. Fannie, Freddie, some other types of stuff. But, man, it's much more difficult. I know, because I just looked at this stuff, right? So a lot of stuff isn't there. In addition to that, the buyers have gone down. A lot of people are sitting on the sidelines. And the reason they're sitting on the sidelines is because they don't understand where this market is going to end, and also for a couple other reasons, which we'll discuss when we get back. We'll be right back with the Del Walmsley Radio Show.
Teaching you with a roadmap to creating the lifestyle you really want. Keep listening. The Del Walmsley Radio Show returns in moments.
Lifestyles Unlimited Success Stories.
If you got laid off tomorrow, what would you do? Would you have to be working at McDonald's or wait to try and find another job with the downsizing the economy? Kept on coming to meetings, even with David Fisher online and stuff like that, but still, we just we need to make the jump.
So we kept praying for time to get this job done, to be able to find the properties. How do we find the properties? How do you find the time? And God answered our prayers, and he got downsized from his corporate job. This house was a dog, and through the rehab, I think we turned it into a little pony.
You bought the house for $73,000?
Correct.
And your appraised value actually is $144,000. You put in $45,000 worth of work, so that leaves you a net equity of $11,000 with a return on capital gain of 70%. The cash flow is $458 a month for a cash-on-cash return rate of 35%.
Join us this month and learn from people just like you. Check in-person and online dates at lucasestudy.com.
You're hearing the Del Walmsley Radio Show. Want more life-changing knowledge? Access our podcast and listen on demand at lifestylesunlimited.com under the radio tab. Now your host, Del Walmsley.
Welcome back to Del Walmsley Radio Show. Today we're talking about why the brokerage firm of Marcus and Millichap is finally admitting after a year that the real estate market has turned around and is going down. Commercial real estate prices are down 10 to 20%, and no one wants to admit it. The commercial brokerage firms don't, and the sellers don't. So here we've got a situation. Nobody's buying because why? Well, because interest rates are so high that the deals don't make sense, that the buyers expect to get a fair price, which means that the interest rates go up, the cap rates have to go up also, which means we have to get a lower price. So the buyers understand that, but the sellers don't and don't want to admit it. And the brokers always work for the sellers. You have to understand that. So I just went through a deal where they went through all these bids and everything, and it finally came down to the fact the seller just would not come down to the price that any buyer wanted to give them. And this is prime real estate. They just figured they'd hold on to it. So that is killing the market for these brokers and these brokerage firms. Nothing is selling. And so the marketplace is just being shut down. Some lenders have walked away. They completely won't lend anymore. They're upside down. And, the bankers don't want to lend. So what's the beauty in all that? The beauty in all that is the story about the people that are losing their deals and or being forced out to sell their deals below even as much as mortgage prices. Now, Marcus and Millichap came back and said, what is the fix for this? And this is where they really watered it down. They said the one fix is a wave of defaults. And they threw it on the table. There it was, a grenade. Then they stuck the pin back in the grenade and said, but we're not seeing that yet. Well, let me tell you, we are seeing that. There are defaults all over the place, not in the volume that there is in a recession or when the whole market crashes, but we're starting to see defaults. And they don't want to admit that there are. They're there. They're saying, yeah, there could be. This could be a way to solve this, but they won't admit it's happening. It's already happening. There's defaults on these loans. And like I said, these things, are being sold, and they're trying to get any amount of their equity back out of the deal they can. Some of the deals are selling, and the banks are saying, look, just take it. We'll take less than what's on the mortgage. So, you got to realize this. The bank knows these deals are upside down. They lent them the money to be upside down on these deals. They know it. Now they got to get it off their books. They don't lose any sleep over at night. They just know what they got to do. They got to get out of these deals. And so they will let somebody come in and buy it out. I've seen it happen. We've seen it happen more than once. And we're going to see it happen again and again and again. What else? They said the Fed could reduce the interest rates. And boy, there they are. Wow, the Fed could just change its mind and go back down on interest rates. No. The bottom line is the Fed said, we got to hold off here this month. They didn't raise the interest rates this month because they didn't want to put any more banks out of business. They're letting the banks get recapitalized before they raise the interest rates. They already admitted there's going to be 2 more rate hikes this year. Now, guys, you say, Del, are you brilliant? No, I'm not brilliant. I just listen to what they say. They say there's 2 more rate hikes coming. Now, the brokers aren't telling you that. Marcus Millichap saying, hey, they may just let interest rates stabilize. And that was the third way they could solve all this, is if interest rates do just stabilize. If over a long period of time, the sellers realize that the interest rates are not going back down, and that if they're going to get out of these deals in any way, shape, or form, there is a new value in town. And there is an adjustment of and a realization to that adjustment of, and it's not going away. And so this slow but sure gradual change in the market's perception of value is what Marcus and Millichap is hoping will occur. Now, I don't really have an opinion. I don't know which one will because I don't have a crystal ball. My crystal ball's in the shop right now. It's getting shined up and didn't work very well. Other than it did work very well when I told everybody not to do the adjustable rate interest rates and or get into the deals where it's interest only and then all of a sudden the interest only ran out and you've got a gigantic mortgage payment to pay now. Those were pretty clear in the old crystal ball that they didn't make sense, and so I told people to stay away from them, and now people are like, yeah, you were right. Everybody's reluctant to admit when they went ahead and went against what is common sense. Common sense says those interest rates are going to bite you. I heard a guy give an argument, and I watched a video the other day. Somebody sent me, said that fixed interest rates are for suckers. Variable interest rates are always lower. Of course they're always lower until they're not, and then all of a sudden they're higher. And so he pointed out the fact in 90% of the time, variable interest rates are just a few clicks lower than what regular interest rates are for taking on the risk that if interest rates go up, right, you can hedge that bet by buying this insurance that if interest rates go up, it won't go up above a certain amount. Unfortunately, he said they missed the fact that those interest rates were evaluated every year and that the underwriting on the loan that they had was reevaluated, and that not only would the interest rates go up, but the underwriting of the loan, in other words, what is the debt coverage ratio that has to be hit, would change. And they didn't think that through. No, nor did I, because that's a pretty high-level thought process thing to figure out. But I didn't have to think it through because I wasn't buying variable rate loans. These guys were saying, hey, you're an idiot if you don't buy a variable rate loan because the variable rate loan gets your interest down low enough that makes these deals work. And if you're a syndicator or you're a broker, there's only one thing in this world that puts money in your pocket, and that's do another deal. So these guys live and die by deal volume, right? And so right now they're out there praying, begging, hoping that they can get out of the deals that are coming up short. The ones where the mortgages are running out, the ones where the interest rates are so high that either the interest rate or the forced accumulation of the cap. In other words, they're making them escrow for these caps now. And if you don't understand what that means, don't worry about it. It's very high-end stuff. You're not going to deal with it at your level of doing real estate investing. And that's the beauty of all this. What I want you to understand is all of this stuff is the problem that syndicators and or arrogant, gigantic investors have because they're not doing it the way I told them to do it, the way I would tell you to do it. They're taking too much risk. They're out there getting too aggressive, and they're now paying the price. If somebody needs to sell, if you run into a situation where they need to sell, they have to sell, they want to sell bad enough, when there's a motivated seller, a deal can be formed. If there's no motivated seller, no deal can be formed. And what is a deal? A deal is when you buy it at or below a price that you're going to be very happy in owning it. Having said that, I promised I'd answer a few questions for people in this last segment, so I'm going to go ahead and get to them. The first one, I'll read it here. It says, when I bought my house in spring, I owned a 2-2 condo. I kept it and leased it. At the time, the depreciation schedule was 17 and a half years. In the middle of the lease, depreciation went up to 27 and a half years, but I was stuck with a 17 and a half depreciation schedule. I learned this. I leased it for 20 years. Now, whoever leased something for 20 years is insane, by the way. I could go on and on about that. That might be a whole show. About half of that time was break even or negative. There you go. The guy just was losing his butt. He should have sold it 20 years ago. When I sold it, I had never heard of Dell or the 1031 exchange, so I paid capital gains on the sales price. So does the IRS consider the value of the property to be zero 20 years later versus the 17 and a half that I depreciated it? Meaning that I sold it for $62,000 and it was $62,000 minus the mortgage balance of $38,000. Boy, he still owed $38,000. This guy got kicked on this thing. And is that what it is? No, it's not quite right. John, the reality is the property has some value because even when you depreciate, you don't depreciate the land. So there's still some value, even after you depreciated it, the entire schedule, the 17.5-year schedule, there's still some land that you should have been able to take off along with the mortgage. All right, moving on to the next one I promised I would get to. It says, I hope the email finds you, blah, blah, blah. My name is Paul, and I'm writing to seek your expert advice regarding the potential refinance of my primary residence. Currently, the market value of the property stands at $300,000 with an outstanding mortgage balance of $100,000. So he's got $200,000 in equity. One of the considerations for refinancing is to access the equity I have built up. I intend to use the equity as a down payment for investment properties. However, I have been informed that if I were to proceed with refinance, the new interest rate would increase approximately 7.6%. Given these circumstances, I have a couple of questions. First one is, consider my goal of using the equity as a down payment for an investment property. Would it be advisable for me to refinance the mortgage? Only if you can pick an investment property that pays you better than 7.5%. If you get one of these deals, like the single family housing we're getting right now, where you can buy it with anywhere from a 10 to 15% cash flow, and you capture 25% to 50% equity instantly, wow, you're making 50% returns, costing you 7% to borrow the money. That makes sense. Around what amount could I get if I extracted the equity? 80% of the total value, so 80% of 300 is 240,000. You owe 100,000. So let's see, you could borrow 80. Well, yeah, in a personal residence, I think you get 80%. So 380 is 240,000. $240,000 is the amount of debt they would allow you to put on the property at the most, minus the 100,000 you already owe. That means $140,000. So you take that $140,000, you go out there and buy yourself about 5 houses that are making you $500 a month positive cash flow, and you'll be pretty happy that you did that, especially if you capture $25,000 or $30,000 equity in each deal, which, by the way, if you listened to the radio show last week, we had a young couple on that was doing just that. They were capturing large amounts of equity and made $250,000 in 2 years on a very small amount of investment. So it is possible. That is what you'd want to be looking at. The last one here real quick, if we can squeeze it in, is my name is blank. I'm 34 years old. I own a house that I've had for 10 years. I have about $200,000 in equity built in the house. I own a small 3-unit RV park. Is rented out to cash flowing that I own free and clear. My question to you is, would you sell the house in the RV park and end up with about $300,000 in cash so I could take that money and go build an investment property? The answer is, or should I refinance and pull the money out and hold on to the property? My current concern. Well, I think the guy later, we passed a few more meals back and forth, said he lived in the house. If you live in the house, I would refinance it and then go buy other additional properties. If you didn't live in the house, I would sell it and go do it. In fact, you could do either. You could keep it, refinance it, and keep it as a rental property, and then go buy more. But the bottom line is, if you've got $300,000 equity, debt equity sitting in the house, it doesn't matter what the interest rates are. The interest rates are going to dictate the price, going to dictate the deal, going to dictate the underwriting, and the deals are still. If you're buying single-family houses out there, we're finding where we can buy them with $25,000 to $30,000 to $50,000 equity, and we're finding them with anywhere from $300,000 to $500,000 or $300 to $500 a month positive cash flow. You add a bunch of those up, and that $300,000 is going to make you a much, much happier person that you own that instead of this little house sitting there with 3 other RV park units sitting with it. So. Hope those answers help you guys make some decisions. The rest of you out there, let's get out in this real estate market and get prepared for what's coming up now, which is a great opportunity in the near future. Have a great day, and remember, it's not the money, it's the lifestyle.
The information and opinions you hear on the Del Walmsley radio show are those of the host, Del Walmsley, his guests, and his callers. The Del Walmsley show is for entertainment purposes only. Please consult a professional regarding your personal investment needs. Nothing presented on the Del Walmsley show constitutes an endorsement, recommendation, offer, or solicitation to buy or sell any product or security.